for joining us today for our webinar, where we're going to REITs. So currently we are in a period where the macroeconomic conditions, particularly interest rate movements, continue to play a central role in shaping investment strategies across the markets. For REITs, especially Singapore REITs and the broader Asia Pacific REITs, the interest rate environment influences borrowing costs, valuation yields, and investor demand in meaningful ways. With markets adjusting to a higher for longer rate backdrop, many REITs have been actively managing debt and refinancing strategies to adapt to changing financing conditions while seeking to preserve distributable income for investors. In this dynamic environment, investors are asking important questions like how do interest rate actually affect the REIT performance and yields? Current rate levels creating buying opportunities or risks? And also, what is the outlook for the Singapore REITs and Asia Pacific REITs in the year ahead? So to help unpack these topics with depth and perspective, we are pleased to be joined by an expert in fixed income and income-oriented investing. So it's my pleasure to introduce Mr. Zhang Dinghai, better known as Bruce, Head of Fixed Income at CSOP Asset Management. Bruce actually leads CSOP's fixed income investment function, responsible for developing and managing strategies across bonds, REITs, and money market instruments, and also supporting the Singapore-focused ETF strategies. So in his role, Bruce oversees portfolio management and business development, while also providing bespoke analysis and quantitative support to both client-facing teams and internal product groups. So his work actually helps position the firm's fixed income capabilities effectively within today's markets. And prior to joining CSOP, Bruce actually held multiple roles at State Street Global Advisors, such as an product engineer, portfolio specialist, and a portfolio manager, where he actually gained hands-on experience managing fixed income portfolios across a broad range of sectors. Bruce also holds a master's degree in economics from the University of Hong Kong and a Bachelor of Arts from the Peking University. He's also a CFA charter holder and an active member of both the CFA Institute and the Hong Kong Society of Financial Analysts. So please join me in welcoming Bruce Zhang as he walks us through the current interest rate landscape and what it means for the Singapore REITs and Asia Pacific REITs investors. Okay, over to you, Bruce.
Thanks, Kane, and also thanks all the investors from the Longbridge to attending session during the lunchtime. Today, I'd like to share how the REITs investors can continue to benefit from the Singapore REITs as well as the APAC REITs rally, and particularly after the Fed cut interest rate last year, and through using the ETF vehicles. And as we enter the year 2026, we do believe most the headwinds, which used to prevent the S-REITs from the further rally, are converted to the tailwinds, such as the monetary policy from the hawkish tone to the dovish tone, and from the rate hike to the rate cut. And inflation also, from the higher inflation to the peak of inflation, now it's becoming a lower inflation, and this in turn lower the cost of the S-REITs a lot, such as the borrowing cost as well as the operating cost. And these are all can be seen here on the right-hand side as reflected in the green arrows. But now there are still the red arrows, the headwinds, which are the growth expectations. Although if you look at the chart here on this slide on the top left, the absolute growth speed within Singapore is still expected to stay okay at around 2.4% in the next this year and next year. But as compared to the year 2024 and 2025, it is already revised lower. The reason behind it is also quite straightforward. If you look at the chart on the top right. This is because exports may be volatile on the back of tariff uncertainties, but Singapore is still highly subject to these external demand trend. So that's why this increase the uncertainties on the growth in the next 2 years. But the good news, if you look at the chart in the bottom left, the inflation is, although a rebound a bit in recent months, it is much, much lower versus the previous peak in the year 2023 and year 2024. So as a result, this as shown on the chart in the bottom right, the Singapore interest rates, the SORA rate, have been lowering a lot since later stage in 2024 and through the year 2025. And more importantly, it is already decoupled from its US interest rate peers. And this is especially benefit the S-REITs because majority of the S-REITs, their funding currency are still in Sing dollar instead of the US dollar. And the restart of the Fed cut cycle can provide some additional boost. Of course, after the rate cuts in year 2025, now in year 2026, the market have split views in terms of the number of further cuts for this year. Someone may expect three cuts on the back of the weaker macro outlook, but someone may just expect one rate cut because they believe the growth will be expected to be resilient even within the United States. But the overall or the market consensus that the interest rate is still in a downward trend in the next couple of years instead of the upward trend as shown by the dots on the right hand side. And we do believe this is good enough for the S-REITs to continue lower its borrowing costs through the debt rolling. And in simple ways, the lower interest rate environment could benefit the S-REITs in two ways. First, it's from the sentiment perspective because all else equal, the lower discount may translate to higher prices. This is quite similar to stocks. And more importantly, the lower rate will gradually lead to the lower debt cost. And if we combine this with the S-REITs are still reasonable debt to asset ratio shown here, the relative reasonable leverage ratio, it means the lower interest rate will imply more growth opportunities for S-REITs to conduct some more value add activities, such as the merger and acquisition activities, and also the asset enhancement initiatives for their existing commercial REIT properties. The Q3 earnings, the reports are also quite okay with the defensive sectors like the industrial, including the growth-oriented data center, as well as the retail REITs. They're still performing quite well, following by those grade A office REITs. The hotel REITs are still under pressure due to the room REITs pressure, but they just account for a relatively small weight in the overall S-REITs portfolio. And the high rating from the sell side here, 5 means the highest rating, and the four to five means also relatively positive rating from the sell side. They are overall still quite positive and also echoed by a still quite good occupancy ratio for the S-REITs. And additionally, the lower interest rate will benefit the cyclical names in particular. And looking forward, we believe, given the low interest rate environment, the S-REIT earnings upgrade cycle, it can still be anticipated, such as the further DPU uplift. And it's quite important to note that now this kind of earnings upgrade is not yet to be fully priced in. This is because last year the pricing still expecting the rate cut and haven't reflected those earnings upgrade. But now we can think about the earnings upgrade to also be reflected in the current valuation. And with the support of the interest rate tailwinds and the stable, let's say the S-REIT operating results, we do believe the price re-rating will be will happen for this and year and even for the next year. And additionally, the lower interest rate can also reignite some capital market activities. This is quite, the reason is also quite simple. This is because the average cost of capital now is falling on the lower end of the acquisition range. This means that the REITs they can earn higher returns on their newer property acquired than their costs, which will in turn boost the merger and acquisition activities as shown on the bottom right chart. And despite the strong rebound in the year 2025, the current valuation are still quite okay or attractive for entering the S-REIT re-rating cycle, because the price to book level is traded just at around one multiple, which means that there's still room for there to rally further. And additionally, the MAS initiatives such as the EQDP last year to increase those liquidity for the non-STI member are expected to narrow the yield and valuation gap between the large and mid-cap S-REITs. This is relevant because under these EQDP initiatives, in addition to these, or except for the top 30 names in the STI, the next 30 or next 50 names, typically the mid-cap names, within this universe, there are 30 to 40% underlying names actually are the mid-cap REITs. So that's why they can benefit from these initiatives. And in terms of the sectoral outlook, I really love this the DBS Singapore property clock. In addition to the residential property, which can still see some further upside, moving to these commercial REIT sectors, the office and industrial REITs are still expected to perform well thanks to the favorable supply and demand dynamics. This is because even we see some the let's say the uncertain macro outlook within the industrial REITs. We are not only having these plain factory or the business parks. We also have the logistics, which are important to the internet for goods era. And also for the data center rates, they are continue to benefiting from these AI spending, although there are some concerns about the AI bubbles. But now the capex in the hardware, the capex in the data center, in the computing power, these kind of things are still real. So they are materializing and benefit upstream industries. And this and for the office rates, this is also true. This is because although the macro growth can be uncertain, but there is always winners in the different market cycles, and they have a strong demand, a rigid demand for those, let's say the CBD offices. For example, in the past several years, although the traditional financial industry they're leaving, or even for some tech firms they can't come in and out. But now for the wealth platforms, for the new economy, and also for those legal firms, their family offices, they are moving to the Singapore's the CBD areas, which means at least for the Grade A offices, they are still have some favorable demand, and these can be further boosted given the limited supply in the next couple of years. And this is followed by the retail rates in terms of the outlook, because for the Orchard malls, it seems as long as the tourists would like to spend more, though for those core areas, the spending should be relatively okay. But for suburban malls now, we see some problems because the RTS will be open soon. I think it will attract more Singapore domestic consumers to move their spending to the JB area, maybe including myself. So these can be that's why here the outlook for the retail rates is more mixed. And in contrast, the hotel rates are still under pressure, as I mentioned, after the revenge spending demand is faded away. The supply spike now is put a lot of pressures on the hotel REITs outlook. Since the year 2022, as you can see here, the dark blue line is the S-REITs performance, and the shallow light blue line is the STI performance. The S-REITs has underperformed its Singapore equity peers due to the high for longer rate environment, which typically benefit banks. But now, on the back of the lower interest rate environment, we believe the gap is expected to be narrowed thanks to this rate cut cycle. But even the banks can still be resilient due to the other business like the wealth management routes. We still believe that as REITs can gradually catch up, if even if this trend will be not fully reversed. And sometimes we were asked about the role of the REITs as compared to, let's say, the traditional equity, bond, and cash. I think from a dividend yield perspective, as shown in the left-hand side, the S-REITs can, in terms of dividend yield, can beat the STI, the Sing dollar deposit or the risk-free rate, the 10-year yield, as well as the inflation. And more importantly, if you look at the chart scatter plot on the right-hand side, when comparing the regional equities and REITs peers, the S-REITs can achieve almost the most competitive dividend yield as shown by the green diamond. But these are attractive yield is achieved through a relatively low volatility. So this could translate to a better return risk ratio versus its regional stock and the REITs peers. And the S-REITs can also act as a good hedge to the inflation because the rental fare is also key components to the overall CPI basket. And in Singapore, those are leading REIT names can easily pass their higher cost to the end tenants or even the end investors. That's why in the next couple of years, the S-REIT dividend yields are still well above the domestic and even the global inflation. So to capture this market rally or the beta rally, our CSOP ETF uses the SGX, the Edge S-REIT Leaders Index as our benchmark. So in simple words, we tend to include the 2022 largest and most liquid S-REIT names to capture the sector rotation. Now the industrial REITs, including data center REITs, together with the Grade A office as well as the retail REITs, will dominate our portfolio, which means it can be resilient over different market cycles. And if you look at the chart in the bottom right, the nearly 60% of the underlying projects are within Singapore, with others in the Asia Pacific or even in the global. But since all the REITs are listed on the Singapore exchange, the individual investors, regardless of residence, regardless of nationality, your withholding tax will be zero. And if you look at the top 10 holdings of our benchmark, you can see most of them are supported by the sovereign investor like Temasek or the REIT sponsors like the Capel and also the global large asset managers. So these implies the safety, potential better pipeline arranged by those sponsors and even the reasonable debt structure to handle this cost problem. And investor here may ask that if the S-REITs are still popular, let's say, why don't they directly buy them? I think it's definitely okay, but only when the investor has a very high conviction on certain REIT names. But investor should also pay attention to the, let's say, the concentration risk as well as the liquidity risk. And that's why we believe the ETF can be in place, and we are not afraid of disclosing our daily holdings on daily basis on our website, because there are three points to supporting the case for using the ETF like our ETF. First is the stable and decent dividend, as you can see here, because when you buy the single rate, your dividend volatility can be higher, and also it's hard to predict. But if you use a weighted average of basket, these dividend yield can be much more stable and easy to predict. For example, since our ETF, SRT, incepted in November 2021, the average annualized dividend yield is around 6%. And now, despite the restart of the rate cut cycle, it is still around at around 5.5%, which is 350 bips higher than the Singapore 10-year yield, still quite a decent pickup. And second is about the lower volatility. As different rates, they have different sectors, and some can even have a different country exposures in terms of their projects. So the less than one correlation, they lower the ETF volatility versus all of its underlying holdings, and in turn lower the drawdown in aggregate as well. And third is more links to the ETF vehicle because it has a cheaper trading cost. As I mentioned, investors, it's not hard for investors to copy our ETF, the basket on the Singapore exchange, but individual investors may suffer from a much wider bid-ask spread, the trading cost, through this price quote from your counterparties. And the entry threshold is also a bit higher, such as Sing dollar, starting from the Sing dollar 3,000 to copy the whole basket. But an ETF vehicle like our ETF could easily leverage our firm's dedicated trading desk to lower the cost and translate into a much tighter trading spread for the ETF. Here is less than half of the underlying average trading cost. So this can help investors lower their overall cost and also can lower their entry barrier, because when you're trading an ETF, the trading lot start from 1 instead of 100. Then you can start to invest. Theoretically, you can start from the Sing dollar 0.1, 0.8 per share. And page 23, it's a snapshot of our ETF, Singapore listed ETF. The ticker is SRT for the basic share class. And now our AUM is more, it's around Sing dollar 130 million. And all the information is available at our company website, but it's easier to remember some key points in the next slide for sure. Here are some common Q&A asked by our clients. I'll quickly read them through. First is the SRT dividend yield. And now the index yield is still at around 5.5% annualized. It's not a bad number. And the dividend payment frequency is twice a year. Ex-dividend is January and July. Payment is in February and August. And unluckily, today is already the ex-dividend date, which means today you can, even you invest in today, you cannot receive the payment in February. But the good part is that after this ex-dividend, then you can start to accumulate the next round of the dividend to be ex-dividend. Dividend, and also to be paid in July and in August, respectively. And currently, the fee is capped at 60 bips, which means regardless of the portfolio size, it will be capped at the 60 bips at most. And which counters are available? Now the two counters, SRT is for the SGD counter, and SRU is for the US dollar counter, but both will pay dividend in the Sing dollar. And what is the minimum trading lot for the SRT? It's just 1 unit, around Sing dollar 0.8. And even for the primary creation and redemption option, like when you buy a mutual fund, we also have this second option. You can start from the 50,000 units or at around Sing dollars 39,000. This one, it's an additional option in addition to the exchange trade. It's also not a mission impossible for the individual investors. And how to compare the SRT to the peer REIT ETFs on Singapore Exchange? I think our SRT provides a large and mid-cap focused to help investor to capture the broad-based market rally. And also, since we have some liquidity screening, all those underlying are very highly tradable. And also, this is a pure S-REIT exposure. So, which means the withholding tax is not applicable to the individual investors. And for the Sing dollar counter and the US dollar counter, which counter should be used? In simple words, if you have Sing dollar at hand, you can trade the SRT, and if you have US dollar at hand, you can trade the SRU. But if you take certain foreign exchange, the FX view, you may convert Sing dollar to US dollar and vice versa. For example, of the last year, Sing dollar continued to appreciate versus US dollar. So when you use the US dollar to invest in the, let's say, the Sing dollar denominated SRT, in addition to the price rally, in addition to the dividend yield, you can also enjoy the additional FX gain because you use a weak currency to invest in currency which are still strengthening. And particularly as compared to our SGX listed peers, the other four peers, we have the highest indicative dividend yield and also relatively fair price to book value. And when we directly compare our major S-REIT ETF here, as shown on the bottom two charts, in the history, we tend to perform well during the bull market because we focus more on this liquidity and market cap, which means we're quite sensitive to the market change, both upside and downside. But since we are in the recast cycle, rates are still expected to rally further. So this means investing in our ETF may benefit more from this market rally. And this is also echoed by the outperformance since the week of the Liberation Day, which is in April last year. And lastly, for the S-REITs, despite the double-digit 15% rally in year 2025, we believe there's room of a further rally for the S-REITs because we are just back to the level before the Fed hike in early year 2022. And also, since the inception, we managed to outperform our benchmark by around 50 bips per annum, which can pretty much offset our 60 bips TER. So the investors can access the market performance with relatively a cheaper cost. So this is pretty much for the S-REIT part. Now I'll to share another portfolio. This is the second one for the APAC one. Because as compared to the S-REIT ETF, which is still closer, of course, there are 40% exposure in global and in APAC. The S-REIT ETF is closer to a single country strategy. Our APAC ETF, it's a regional REIT strategy, including the REITs not only in Singapore, but also in developed markets in the APAC region, such as the Australia, Hong Kong, and in Japan as well. And if you look at the page here, as shown by this 2025 full year return across different asset classes, it's surprising to see that the APAC REITs performance even better is close to 25%, which is even stronger than the Nasdaq, thanks to the REIT cast cycle and also the resilient underlying REITs fundamentals. And the APAC REIT market universe is also growing very quickly in recent years. And now, as shown on the right-hand side, the APAC REIT market is already the second largest REIT market, second only to North American market, and larger than the overall EU, the Eurozone market. And within the APAC market, the interest is concentrated in the office and logistic assets in Australia, Japan, and also in Singapore, which means the regional strategy has a highly diversified exposure. And very similar to the S-REITs, if you look at the right-hand side, the APAC REITs can be traded like stocks on the exchange. and providing a liquid access for investors to access the property market. And it is also have some tax efficiency. And as compared to their respective equity, fixed income, deposit yield, and inflation, similarly, the APAC REITs have the additional yield pickup, and this pickup is achieved without at the cost of these higher volatility, which means the dividend yield is decent and the volatility is moderate. And as half of the markets have the zero withholding tax, and the rest markets have the lower tax than their US or European rates. The average APAC rates, the withholding tax is much lower than their Western peers because the US, Europe rates, their withholding tax can be as high as 20 or even 30%. But on average, the APAC rates, the withholding tax around 16%. And more importantly, all the markets, they have in the APAC, they have the minimum distribution requirements to ensure that income generation for the end investors. And this translates into more competitive yield than their US and European peers net of the tax. And likewise, on a forward-looking base, the APAC REITs, their expected dividend yield can beat their respective markets inflation in the next couple of years, acting as a good or effective inflation hedge. And again, as compared to the US and EU REITs, it seems APAC REITs have better diversification or lower beta benefit versus the US equity market because starting from Liberation Day last year, more and more investors they tend to diversify out from the US equity market in terms of these the earnings outlook uncertainties together with the stretched valuation. So which means the APAC REITs could provide another route for investor to switch a bit out of the US stocks for now. And more importantly, the APAC REITs not only simply are benefiting from the lower interest rate, their fundamentals are quite solid as reflected in the low debt together with the stable rental income growth. This is also echoed by a lower drawdown versus the US stocks during the Black Monday a week in April last year, because at the time the S&P they dropped suddenly by more than 9%, but the APAC rates their drawdown at that time is just around half at around negative 4.8%. But after that, it rebounded very quickly from that level. And after the previous years the previous year's high interest rate environment, the APAC risk valuation is already quite reasonable and attractive. And now that we are in a rate cut cycle, it is possible that the APAC risk to extend this rally or even repeat the very strong rebound happened in the year 2019 to 2020. And the forward-looking data also indicates in the red box, that indicate a decent dividend yield growth speed for the APAC rates at around 5.55%. It's quite easy to remember. So to quickly summarize the market side or the strategic case for the APAC rates, I also had a relatively attractive dividend yield with the low volatility, and compared to the US and European rates, the APAC rates has a lower average withholding tax, and also quite has a good features to beat the inflation. And the diversification benefits also quite obvious because they're lower volatility correlation versus US equity. And they also have a diversified exposure across the developed Asia Pacific area because as compared to emerging market, they develop markets REITs have a more stable, more resilient and cautious, prudent capital structure. On a forward-looking basis, they can also benefit from the overall rate cut cycle from in the US and in selected markets within the APAC region. But more importantly is that their dividend can also expect to grow in the next 12 months. So that's why we have our APAC REIT strategy listed in Hong Kong, also in the form of ETF in place. And the main difference versus our S-REIT ETF is that this dividend payment frequency is quarterly, and our SRT is dividend payment frequency is half yearly. In terms of the index construction, for this APAC REIT ETF strategy, we use the FTSE flagship and the REIT index. It's quite famous in this REIT ETF industry, but focus on the diversified exposure across the sectors and developed markets in Asia Pacific. And after the market cap and liquidity screening, as you can see here on the right-hand side, it's also quite diversified. And the top sector is diversified REITs, and followed by the industrial, retail, and office as well. And in terms of country or market allocation, now Australia and Japan dominate the portfolio, followed by the Singapore and Hong Kong. We also have a certain exposures such as the link REITs. This portfolio now contains the 50 leading names in APAC, such as the Goodman in Australia, Linkris in Hong Kong, or Capital Land in Singapore, as well as the Nippon Building in Japan. So we'll only include the names with the largest cap one, but still with a certain liquidity threshold. And at the second level, as I mentioned, the ETF strategy includes both the cyclical sectors like the office, retail, and hotel, as well as the defensive sectors such as industrial and healthcare REITs, which means it keeps some upside potential, but also providing some downside protection. And similarly, the diversification advantage is reflected in the lower volatility and also lower drawdown than most of their underlying holdings support a case for ETF again. And the past 10 years index performance also quite decent with the stable volatility. And more interestingly, after 3 years negative return from year 2022 to year 2024, the APAC REITs rebounded very strongly in year 2025 on the back of the lower interest rate environment. And this rally can expected to be extended to this year as well. And also, very similar to the SRT ETF, this APAC ETF strategy has compared to directly holding the physical property and single REITs. The APAC REITs they can provide some diversified exposure or with a friendly entry threshold as well. And the liquidity and transparency are very high for the ETF vehicle because you can easily trade it on exchange or use the primary creation redemption, and the holdings are disclosed daily basis on our website. And the dividend yield are also quite stable and predictable for now. And in this last section for my side, I'll also quickly talk about the regional risk outlook because look back to the year 2025, the APAC REITs outperform its US peers. And within APAC REITs, Japan is the best performer, as you can see here in this performance table. Within the Japan, despite the monetary tightening cycle, the better fundamentals are actually supporting the J REITs, particularly after this new prime minister is onboarded. And this is especially true for those office sectors in the Greater Tokyo region on the back of the favorable supply and demand dynamics. And Australian REITs also delivered decent return last year. Well, the rate hike expectation may be a headwind to the A REITs, the Australian REITs. The strong population would benefit the retail and the residential REITs, and data center demand together with the bottoming out of the office REITs from a low base could also benefit the Australian REITs. And for Singapore, I'll skip that because I mentioned this in the previous deck. But specific to the Hong Kong REITs, the link REITs, it seems there are no signs of the improvement in its rental reversions. This is mainly because of the very aggressive pricing strategies by the mainland e-commerce operators and shops, and also there was a direct competition from their Shenzhen shopping malls versus Hong Kong shopping malls. So that's dragged down the Hong Kong link rates a lot. Although the Hong Kong HKMA they follows the US with an easing bias, but there's still some hopes, such as the upside potential from these future the stock connect inclusion, because now the China and Hong Kong stock connection only including the equities and haven't included the REITs. But once the REITs can be included under this southbound stock connection, then the link REITs can still have some hope to receive the southbound flows from the mainland China investors. So to quickly summarize, we CSOP provide both the regional and single country REIT ETF solution in Asia Pacific to help the investors access the developed market rate exposure with the cost and tax efficiency. And through our ETF, investors could earn the stable and decent yield with some diversification benefits and also the potential cost efficiency. So perhaps I can pause here and stop here and pass back to Kane to help talk about the APAC REITs, the product, and then we can enter our Q&A session. Thanks. Okay, it's your turn now.
Okay, so back to the beginning. So on this slide, we are highlighting the 3447 HK. It's a CSOP AP REITs investment, which is available for trading on the Longbridge platform. So very briefly walking through the key details shown in the table. So the fund actually adopts a representative sampling strategy to gain exposure to Asia Pacific REITs and actually track the FTSE EPR and A in the REIT APAC REITs index. So the base currency is in US dollars with secondary market trading in Hong Kong dollars on the Hong Kong exchange. The lot size is 100 units and primary market creation and redemption are conducted in the USD on a cash-only basis. So in terms of the cost, the fund has an ongoing charges of 1.59% per annum, which includes a management fee of 0.99%. And also, the fund actually follows a quarterly distribution policy at the manager's discretion, and the trustee and register is HSBC Institutional Trust Services Limited. So yeah, that's a quick overview of the key information reflected on this slide. And now we'd like to move into the Q&A session. So if you have any questions for Bruce, just please go ahead and type them into the chat or the Q&A box.
Yeah, thanks, Kane. It seems like under the Q&A session we'll see some questions. Maybe let me solve those questions first, and we welcome more questions in the Q&A or in the comments area. The first one is what is the biggest potential risk for S-REITs in 2026? I think, as I mentioned in my presentation, now we don't think the interest rate is the biggest risk anymore because even the Fed may stop or pause or postpone their rate cut in the year 2026. Now the market, there's nobody to expecting the rate hikes. And as I mentioned, since the interest rate is already peaked in the late 2024, which means that even there's no more cuts, there are no more cuts. The S rates, or even the APAC rates, their overall debt will be getting lower and lower because they're rolling their debt to roll in the next couple of years. Their cost can be lower than their previous existing debt. I think the one exception can be from the Japan because Japan is in a tightening cycle. But the Japan REITs are really smart in the past several years. They tend to lock their debt in the fixed debt portion and also extend their debt to the longer tenor, which means even the Bank of Japan will finally to continue to hike its rates. It will not impact the Japan rates that much. I think that's for the first question. And for the second one, among the four markets, Singapore, Hong Kong, Japan, Australia, what's your preference? I think I touched a bit in the deck. This one, I would say, overall speaking, the Singapore REITs, they have a very highly diversified exposure, so they will continue to benefit from their, let's say, the REIT cost cycle, and also their diversified exposure can help them to weatherstand with how to say, to provide some downside protection. Even the market macro environment tends to be against the overall cyclical names. For Hong Kong REITs, I think they still have some risk. They because of their fundamental reason. So it takes time for them to recover. And for Japan REITs, despite the high tightening cycle, the fundamentals are quite strong. And for the Australian REITs, the biggest risk is from because the RBA, they change from the hawkish tone to the dovish tone. This is from the dovish tone to the hawkish tone. So that's the biggest risk, but the fundamental are still quite okay. So roughly speaking, Singapore I will still rank the best, and followed by the Japan, and then Australia, and then the Hong Kong REITs. But to capture the beta rally, so using an ETF is perhaps the safest choice. That's for this question. And the next one is, do you think the Singapore APAC REITs can then extend their rallies even if the Fed slows or stop its rate cut this year? I think, as I mentioned, this the rate cut is no longer the key reason behind that, because the underlying REITs, they manage their cost very prudently, and their overall debt will be getting lower and lower, or they can be extend their debt into the longer tenor. So we don't need to worry too much about the Fed continuing cut, but should re-emphasize on their earnings for this year, because last year the price rebound for both S-REITs and APAC REITs is more for the rate cut expectation. But for this year, the pricing will give more weight to the earnings, to their operating results for those REITs. And next one is, how does SRT and APAC rates compare with CFA? Yeah, quite good question. I think maybe I start from the SRT one, because CFA, it's a Asia REITs ETF focusing on the emerging Asia REITs, but SRT is a only investing in the S-REITs on Singapore Exchange. I think this means the SRT is more subject to the Singapore related macro and fundamental change, but the CFA, they are subject to the overall emerging Asia REITs outlook. I think that's one difference. And second one is that the SRT, when invest in SRT, because the underlying is all S-REITs, the withholding tax is technically zero. But for CFA, they may still subject to some withholding tax for certain markets. These will be reflected in the price traded on the Singapore exchange. I think that's the key difference between SRT and CFA. But when comparing the APAC rate and CFA, this can be also quite different, because our APAC rate ETF strategy in Hong Kong, it focuses on the developed markets in the region. But the CFA, they have some developed markets, but the majority, or the quite big portion, are still within the emerging market. When we compare the DM to EM, it's not a black and white argument. But if you look back at the history, I would say that the developed markets rates, they are more prudent in terms of their capital structure and more defensive, which means if you experiencing some market downturn, then the developed market can be more defensive versus the emerging Asia rates. So it's not simply a good or bad argument. I think that's pretty much in under the Q&A session because this last question is the same. They repeat it again. Yeah. But in simple ways, we want to create something which is not existing in the Singapore REITs ETF market. So to provide some additional upside for the S-REITs, particularly using our SRT, and provide a more diversified, developed market focused regional strategy to complement the existing SGX listed ETF. Yeah.
Okay, thank you once again for all your great questions, and a big thank you to Bruce for taking the time to answer them and share his expertise with us today. So we hope you found the session informative and that Bruce's perspective has given you useful takeaways for navigating the current interest rate environment and evaluating opportunities with the Singapore REITs and Asia Pacific REITs landscape. So once again, thank you again, Bruce, and thank you everyone for attending today's session. So this concludes our webinar. Have a wonderful day ahead.